The 2018 new tax law changes. We're going to discuss the individual taxpayer, not the corporate updates. And we're not just going to focus on federal employees. This is going to apply to everyone. My name is Neil Kane. My bio is here, and it can also be found on our website. So I'm not going to go through these bullet points. I'll save you for that on that, and I'll go right into the tax law updates. This is called the Tax Cuts and Jobs Act. It is the largest tax overhaul in 30 years, and it was just signed into law by Donald Trump and takes effect January 1st, 2018 of next year. The majority of taxpayers will end up paying less taxes, although if you live in a high tax state, if you have mid to high income, you may pay a little more. As you can see here, the tax brackets, the individual tax brackets, and joint tax brackets, each rate is a little bit lower along the way, except for the very bottom tax bracket. The standard deduction has gone up. It's higher. It goes up to $12,000 for single filers, $24,000 for joint. Sorry, we should have put that in there. The personal exemption deduction of $4,450 per person in your household goes away. All right, so if you had a big family, that's going to affect you negatively there. But the child tax credit goes up to $2,000 from $1,000. That's for children that are 16 or younger. But essentially, we have a higher standard deduction. That means less people will be itemizing their taxes going forward. State and local tax deductions. This is where we have a big change. This essentially goes away with one exemption. You're allowed to take $10,000 of any combination of state income taxes or property taxes, which means if your property taxes were $6,000, your state income taxes that you paid were $6,000, you were able to deduct $12,000 of taxes. But going forward, you will be capped at $10,000 on that $12,000 of taxes that you pay. And that's going to hurt people in high state income or high state taxes, like New York, California, Washington, D.C. Washington, D.C. has an 8.95% state income tax. That's going to hurt folks there. Maryland has a 5.75%, and Northern Virginia has a 6%. Those aren't considered high state income tax states, but you might feel it there for folks that live closer to DC that have higher property tax values. The mortgage deduction, this gets retained with changes. Now you can only have a loan up to $750,000 that can be deductible. If you have a loan greater than $1 million and you had that as of December 15th, you get grandfathered in and you can deduct that full amount. But you can no longer deduct home equity loan type products, home equity lines of credit. Those things are no longer deductible 2018 going forward. People were able to deduct up to $100,000 on those. Those go away. The estate tax exemption goes up in double for both single and joint, which means that if you have an $11 million estate, $11.2 million estate or under, you have no estate taxes. So this essentially is going to make it so that the average person is not going to have any estate taxes. There will be very little people paying estate taxes, although this does help the rich. Folks like Trump will benefit, pretty greatly from something like that. Other tax updates. The long-term capital gains rate, there are no changes, which means that assets held for 1 year or more get special tax treatment, 15% flat tax rate or less if you have low income. So do qualified dividends, so there's no changes to long-term capital gains. The residence gain sale exclusion, there's no change, which means if you live in your home for 2 out of the 5 years, you sell that home, you get an exclusion of $250,000 of the gain that you had for single filers and $500,000 for joint filers. The medical expense deduction, this gets retained, although there was discussion of this going away, which means that currently you had the ability to deduct expenses, medical expenses that exceeded 10% of your adjusted gross income. This actually gets better because the hurdle rate goes down to 7.5% for 2018, 2019, which means that more people will be able to deduct medical expenses because there's a lower threshold there of 7.5% rather than 10. So that gets improved. The charitable contribution, there's no change there. So you can continue to contribute to charity and get that deduction. Roth recharacterizations, this gets repealed. The ability to do a Roth conversion is no longer, which was a Roth recharacterization. So that means you got to pay attention more to your income taxes before you do a Roth conversion, because you will not be able to recharacterize it if you do too much, because that's going away. Miscellaneous deductions, this gets repealed. Although most people didn't actually have this as a deduction, because you had to have expenses over 2% of your adjusted gross income for them to be deductible. These expenses included unreimbursed employee expenses, investment expenses, tax preparation fees. Those go away. So this concludes the individual tax changes for 2018 and going forward. We hope we found this information useful. As always, if you have questions, feel free to email us. We do have some upcoming training sessions in the DC area at some different government sites, as well as in our offices in downtown DC on I Street, the Farragut area. I'd love to see you at one of those training sessions. We thank you for attending this workshop, and we hope you have a prosperous new year.